In today's video, we're going to talk about risk and what that means for you when you're buying your next investment property. This is one of the things that gets overlooked time and time again when people are working out, hey, look, I want to buy an investment property. They don't sit down and think about the risk that comes with the investment property. So you get three types of risk. First of all, you get the high risk, and I'm going to jump into that, what makes it a high risk. And then you've got medium risk. This is where a lot of investors tend to sit in. And then you've got your low risk, and that's probably where I buy a majority of the property investments for myself and for clients, more set and forget locations. So let's start to define the types of risks. When we start off with high risk, so what makes an area a high risk location? Generally, they've got a small population, so I would say under 40,000 people. And the main thing and the key factor to this location, making it a high risk location, is the economic diversity. It's normally strayed towards one sector, whether it's mining, which is mainly the topic with high risk areas, and it's more than 60% of the economy in that little area is really driven by the mining sector. So these areas are great from a yield point of view. So you can get upwards of 9% to 10% yield, which is phenomenal, and it looks great on paper, like you want to get the cash flow. But what happens with these markets is when the mining sector drops off, or whatever sector it is, that market tanks at the same time. So really, if you buy this 500K asset and you're just, you're getting the cash flow, but it does spike up in times, but it does go tremendously low when it crashes. And the thing is, like, you need to think, hey, look, if I go and spend 500K on this asset, can I sleep at night? Like, if the mining sector crashes overnight, there goes your 500K investment property. So you'll find that these higher risk areas, they tend to fluctuate dramatically, like insane. And then the other part is that they do offer things like higher yields, but you just gotta tread lightly. So I've spoken to so many people over the years, and they've brought in these mining towns, and hopefully they've done well out of it. But you just have to really time those markets. You got to get in, and you got to get out at the right time. So you got to be quite active with watching that market and watching the trends within that market. When you start to see it start to pull back, you make sure you get out very quickly. But for most of the everyday investors I work with, they don't have time to sit on the data platforms every week to double check to see how a market's going. So that's your high risk type of asset. Your second type of asset is your medium risk asset. And these are in areas that are predominantly regional towns, not like regional cities, but like regional towns. And these regional towns tend to have a population that's more than 40,000 people. I try to make it a guide to make sure this regional town's got more than 100,000 people. And then the other part to this is that they have a very diverse economy. So you can get these little towns that have a smaller population, and if they've got a diverse economy, that then means that there's jobs in it could be the hospital sector, there could be banking, there could be just a range of different economies, and you can go on and you can double check. There's plenty of websites to go on and check how diverse the economy is. The second thing is the population growth. So you want to see this area constantly growing in population, whether it's 3 or 4 or 5% per year. That gives it the green light. So you go in, you obviously double check each suburb, but that's what makes a medium risk property. The biggest indicator between the low and the medium risk is that, the medium risk tend to be in more regional towns. And the second thing is that you have to be quite active in a sense that you just have to kind of keep an eye on the market, because if this area loses its diversification in regards to economy, then you might want to sell out of that market. So that type of market, you kind of want to be a bit, not super active, but a bit active where you're checking maybe every 6 to 12 months to make sure that it's still going strong. But you'll find that a lot of these markets are pretty good for the short to long term, and a lot of them haven't seen massive downturns like a higher risk market. But the beauty about these medium risk areas is that you can see yields from 5 to 5.5%. So they're much higher than what you'll find in a low risk market, which I'm going to get into in a minute. An example of a medium risk market is, I wrote it down, Geraldton over in Western Australia, but there's plenty of other examples out there. But now we're going to go into the last one, which is low risk. So low risk is where I like to play a lot more with clients. This is areas where you know you're going to get a good, steady, long-term growth. This is where you kind of are buy and hold it for 15 years and not have to think about it essentially, because you know over that 15 years, it's guaranteed to grow. So when we start to think of low risk areas, we're looking at your major capital cities, and you know, you can tell that they straight away off the bat, they're always very diverse. That's where the main economy lies. And then you can start to look at some more regional towns, like, you know, Townsville can fit in there because it's quite diverse with its economy and there's a lot happening up there. And then, you know, other areas in Melbourne could be like Bendigo. The economy is very diverse there. So you're mixing it up between your metro cities and also your regional towns. And when you look at the data, you're actually looking at the charts where you're looking at the growth cycle, and what you'll find is that there is a trending line that's going to go directly up. You're not going to see these massive dips and these massive increases in prices. It's more steady, and it's around that 7% annualized growth rate. This is for your investor that is looking just to buy and accumulate investment properties over time, and they don't want to be checking how a market's going every 6 to 12 months, working out if they should sell the property. You know, you're buying in these areas for the long term, and you know, you buy, say, $1 million worth of property there, you should come back in, say, 10 years time and it's $2 million. So, you know, you're getting that perfect double in value. But the trouble is with these lower risk markets is they don't get the yields like you would in your medium risk market. You're probably looking at more of a 4.5% yield, but it's a bit of a trade-off with the cash flow to getting into a lower risk market where you're just buying and you're holding and you're having more of a passive approach. So I hope this really helped you in regards to, you know, working out if you're going to go for a low risk market, mining towns, your medium risk market, you want to add a little bit of data and review those areas, or lastly, your low risk market, whereas you're set and forget. A lot of people I work with are more on the set and forget side of things, and they don't want to be having to worry about how their investment portfolio is going. They're just buying it and they're holding it for the long term. So next time you're buying a property, don't just look at the price and the yield. Think about risk. Do you want high returns with high volatility, or a balance of growth and cash flow, or a long-term safe bet? Understand the market that aligns with your strategy and you'll make a smarter/more confident decision every time. If you got some value from this video, please give it a like and subscribe. I'm creating more content around property investing. I help a ton of investors each and every day, and I get the same questions, so I thought I'll start to make these videos just to help the everyday investor understand the property market and how to invest in property.